Welcome back. New retail sales numbers hit the screens in Canada at 8:30 a.m. Eastern Time today, about an hour and 15 minutes ago. Our next guest is a veteran Canadian economist who, among other things, expects a turnaround in per capita consumption in this country in 2025. Sal Guatieri is senior economist and director of economics at BMO Economics. Sal, thanks a lot for joining us. First of all, your reaction to this morning's retail sales numbers. They were for the month of December. They were stronger than expected and meaningfully so. The value of all retail sales in December grew, StatsCan said, by 2.5% from November to December. That was much more than expected. And excluding automobiles, which of course are very large ticket items, the beat was also significant. Measured that way, the value of retail sales in December grew by 2.7% over November, and that was significantly stronger than expected as well. There was a flash estimate as well, which calls for retail sales to contract in January, but just under half a percentage point. What's your takeaway on these stronger than expected December numbers?
Well, Canadians capped the holiday shopping season in high style, spending at the fastest rate at retail outlets in more than 2 years. And that strength just cut across all major subsectors, all provinces and territories. So it suggests to us that the partial sales tax holiday really wasn't the main driver of that sales increase. And price increases weren't a driver either, because they really did not inflate the value of sales at all. Volumes were up similarly, 2.5%. In the month. The only blemish in the report is that Stats Canada's initial estimate for January does suggest a moderate decline, 0.4 of a percentage point, but that's just a minor payback from the burst of spending at the end of last year. So I wouldn't read too much into it. What these numbers tell us is that Canada's economy is picking up, probably closer to a 2% rate in the fourth quarter at an annualized rate, and it's being led by the consumer. No surprise, Canadian consumers are responding to these lower interest rates. They were very sensitive to rates when they were going up, and now they're equally sensitive, it appears, now that rates are coming down. We are seeing a notable pickup in credit growth and, of course, now spending. So that's probably the main reason we're seeing the pickup in consumer spending. The other reason is we've seen a real burst of job growth through the turn of this year. In fact, 91,000 new jobs created just in December alone, and over 400,000 now in the year to January. So that's generating a lot of income and really providing a lot of backbone to this pickup in spending.
Why, Sal, do you believe that you do not? Why do you not believe that, or why do you believe that the tax holiday was not a significant driver of the strong December numbers?
Well, simply because the strength in spending was so broad-based. It really cut across all categories, even a lot of categories not really covered by the GST holiday. So a lot of sporting goods, for example, that category was very strong. The overall clothing segment, not just children's clothing, was quite strong as well. So just the broad-based nature of the sales pickup and right across the country really suggests that, yes, the GST holiday helped a little bit. Probably wasn't the main driver, though. We probably also did get a little support from the late Black Friday holiday, probably pushed a few sales into December. But again, I think the main drivers here, lower interest rates, stronger job growth.
Okay. You, in a recent report, you asked the question, will Canadian consumers revive in 2025? You believe the answer is yes. You think personal per capita consumption, which has been weak over the past year or so, will pick up in 2025. You have several factors why you think that's the case. Why don't you take us through that?
Yeah, again, the main factor is just lower interest rates. We know that Canadian households highly indebted, and that really showed when interest rates were going up at the fastest rate in decades, as the Bank of Canada was tightening policy very aggressively to control inflation a couple of years ago. consumers really pulled back, and the economy came pretty close to a recession at that time. But now that the Bank of Canada has been cutting rates pretty aggressively, 200 basis points in the past 7-8 months, we are seeing households respond to those lower rates. And longer-term rates have also come down pretty significantly, including mortgage rates. So we are seeing Canadians feeling a lot better about their finances as a result. And they're using that extra borrowing capacity, I guess, to increase their spending. But behind all this is the fact that job growth has picked up quite significantly as well, generating a lot of income. And that really is providing the backbone for consumer spending this year.
One word we haven't used yet in this conversation is tariffs. How does the threat of tariffs factor into your outlook?
Well, it hasn't factored in much so far. We have factored in the fact that all the uncertainty about tariffs is certainly depressing business investment and spending. So we did revise down our economic forecast a bit this year. But if we do get hit with those 25% tariffs on most things that we sell to the U.S., apart from energy products, that will have a meaningful impact on Canada's economy. It could conceivably take us close to a moderate recession. The unemployment rate would go up. Many people will face layoffs. And yes, it's a completely different script for the economy, for the consumer. We'll see a much weaker outcome this year in response to those tariffs. And of course, the counter tariffs, we would see a temporary spike in inflation that would not help purchasing power either. So yeah, it would not be a good situation. The hope is that we avoid those tariffs.
Sal, thank you for this conversation. Sal Guatieri, Senior Economist and Director of Economics at BMO Economics.